Imagine that it is October of 1930. You are not a speculator, you are not a trader, you are not sitting in New York borrowing money on margin trying to get rich in the stock market. You are a farmer in Nebraska. You have worked the same land for 30 years. You have watched good seasons, bad seasons, dust, rain, debt, hope, and fear come and go. You have learned to distrust easy promises, but you still believe in one simple thing: when you put money in a bank, the money is yours. That belief is about to be broken. Last month, you sold your harvest. You took the money from a year of labor and deposited it into the First National Bank in your small town. That money was not abstract to you. It was next spring's seed. It was winter food. It was feed, repairs, medicine, and survival. It was the stored energy of everything you and your family had done. On Tuesday morning, you drive into town to withdraw a small amount for supplies. There is a line outside the bank. At first, you think it is nothing. A busy morning, maybe a teller is sick, maybe a shipment of cash has not arrived, but then you hear the voices. People are not talking normally. They are whispering, arguing, asking questions no one wants to answer. The doors are locked. A handwritten sign is taped to the glass, closed until further notice. You push toward the front. You knock. A clerk inside looks at you, shakes his head, and looks away. He will not meet your eyes because he knows what you do not yet fully understand. The money is still inside the building. The vault is still there. The records still show your name, but access and ownership are not the same thing. You had access yesterday. Today you have a claim, and in a banking failure, a claim is only as good as the assets left behind after everyone senior to you has been paid. That is the first principle I want you to understand. It is simple, but most people never learn it until the worst possible moment. A bank is not a vault. A bank is a counterparty. When you deposit money into a bank, you are not placing your cash into a storage box with your name on it. You are lending money to a private institution. The bank owes you. That is very different from the bank holding your property for you. That difference is small in normal times and enormous in a crisis. In normal times, the machine works so smoothly that people confuse convenience with safety. They swipe a card, the payment goes through. They log into an app, the number appears. They transfer funds, the funds arrive because the system works almost all the time. They believe they own what they can access, but access can be delayed. Access can be restricted. Access can be frozen. Access can disappear behind a locked door with a handwritten sign on the glass. That is not a theory. That is what happened between 1930 and 1933. Thousands of American banks failed. Entire communities lost savings they believed were safe. The money was not lost in the stock market. It was not gambled away by depositors. It was not placed in some risky investment that they misunderstood. It was deposited, it was trusted, then it was erased. The most important lessons in finance are usually the ones people do not want to look at because they threaten the comforting story that the system has already been fixed. The system has been improved. That is true. But improved does not mean risk. Free, the names have changed, the language is more sophisticated. The regulations are thicker, the agencies are larger. The screens are digital instead of paper ledgers. But the core architecture still rests on confidence, leverage, liquidity, and the assumption that not everyone will demand their money at once. When that assumption fails, the structure is tested. And when a structure is tested, slogans do not matter, mechanisms matter. So let us walk through the mechanisms slowly. When you put cash into a checking or savings account, the bank records a liability. That liability is the bank's promise to pay you, but the money itself becomes part of the bank's balance sheet. The bank can lend it, it can invest it, it can use it to support other assets. This is what banks do. This is how credit expands. This is how modern economies grow. It is also why the system is fragile. A bank has short-term liabilities and long-term assets your deposit can leave tomorrow. The bank's loan book may not mature for years. That mismatch is not a mistake. It is the business model. If everyone stays calm, the mismatch produces profit. The bank pays one rate on deposits, earns a higher rate on loans, manages reserves, and the system functions. But if enough people want out at the same time, the bank cannot simply reach into a vault and hand everyone their money. The money has been transformed into loans, securities, and claims on future payments. The danger is not that banks are always badly managed. The danger is that banks are structurally vulnerable to a loss of confidence. Confidence is the load-bearing wall. When confidence stands, the building looks strong. When confidence cracks, everyone suddenly discovers that the wall was carrying more weight than they thought. That is what happened in the early 1930s. The stock market crash of 1929 gets most of the attention because crashes are visible. Charts fall, headlines scream. People remember Black Tuesday, they remember panic on Wall Street, they remember the drama. But the deeper damage came through the banking system. In 1929, America had thousands of banks spread across towns, farms, cities, and regions. These banks operated through fractional reserve banking. If a customer deposited money, the bank kept only a fraction in reserve and lent out the rest. The loan became someone else's deposit. That deposit supported another loan. The same dollar created multiple claims across the system. This is powerful in expansion. It is dangerous in contraction. A small original deposit can support a much larger amount of credit. In good times, that looks like growth. In bad times, it becomes a chain of promises that cannot all be honored simultaneously. Once one bank failed, depositors at other banks began to ask a rational question: what if my bank is next? That question itself becomes the danger. A bank run is not irrational when you understand the structure. If you believe others will withdraw, your rational move is to withdraw first. The first people in line may get their money, the last people in line may get nothing. That is why bank runs accelerate. They are not just emotional, they are game theory. Once enough people believe others are leaving, the safest move for each individual becomes the most dangerous move for the system. This is one of the great paradoxes in finance. What is rational for one person can be destructive when everyone does it at once. That is why I always think in systems you cannot understand banking by only looking at one depositor, one account, or one bank. You have to look at the flows, the incentives, the claims, the hierarchy, and the timing mismatch. In the early 1930s, the system failed because it had too many short-term claims and not enough liquid money to satisfy them. Depositors thought they had money in banks. What they actually had were claims on banks that depended on the banks remaining solvent and liquid. Once that distinction became real, it destroyed lives. A farmer who had saved responsibly could be ruined. A shop owner who never bought a single stock could lose payroll. A family that avoided debt could still be wiped out because it trusted an institution it did not understand. That is the second principle. You can make conservative personal choices and still be exposed to systemic risk. Most people think risk means speculation. They think the person who buys stocks, bonds, property, gold, or businesses is taking risk, while the person who leaves money in a bank is avoiding risk. That is not precise. The person leaving money in a bank has chosen a different risk. It is counterparty risk, liquidity risk, legal risk, inflation risk, and access risk in stable periods. Those risks are quiet. In crisis periods, they become loud. After the Great Depression, the United States responded by creating deposit insurance. The FDIC was established to restore confidence. The idea was straightforward. If depositors believed their money was insured, they would not rush to withdraw at the first sign of trouble. If they did not rush to withdraw, banks would not fail from panic alone. This was a major improvement. It reduced small bank runs. It made the system more stable. It changed the psychology of depositors. But deposit insurance is often misunderstood. It does not mean there is a giant pile of cash equal to all insured deposits sitting safely aside. Insurance funds operate on probability. They are designed to handle expected losses, not every possible loss at once. That is true in every form of insurance. Fire insurance works because every house does not burn down in the same week. Health insurance works because every insured person does not need the most expensive surgery on the same day. Deposit insurance works because the system assumes bank failures will be limited and manageable. But in a systemic crisis, the math changes. If isolated banks fail, the insurance fund can resolve them. If many large institutions fail together, the insurance fund is not the real backstop. The real backstop becomes the Treasury, the Federal Reserve, and the political decision to create liquidity. That may work. It may be necessary, but you should call it what it is. It is not pure insurance. It is a public rescue mechanism, and public rescue mechanisms are shaped by politics, timing, public pressure, inflation, and the perceived threat of contagion. That means you must distinguish between legal guarantees, discretionary interventions, and market expectations. Those are not the same thing when a bank fails and your deposits are under the insured limit. You have a defined protection. Even then, there may be delays. There may be administrative processes. There may be days when access is unavailable. That matters if you need cash immediately. When your deposits exceed the insured limit, the situation is different. You may still be protected in a crisis if authorities decide that letting uninsured depositors lose money would create systemic contagion. But that is a judgment call. In some cases, depositors have been made whole. In other cases, depositors have taken losses. The rule is not simply do not worry. The government will save everyone. The more accurate rule is the government will act when it believes the consequences of not acting are worse than the costs of acting. That is a much less comforting rule, but it is closer to reality. The Silicon Valley Bank collapse showed this clearly. A very large percentage of its deposits were above the standard insured limit. Authorities stepped in and made depositors whole because they judged the contagion risk to be high. That decision may have prevented a broader panic, but it also revealed the uncertainty at the heart of the system. If another institution fails under different conditions, the response could be different. The outcome depends on whether the failure is considered systemic, who is affected, what the political environment is, and how much stress exists elsewhere in the system. That is not a moral statement. It is a mechanism statement. And in investing and money management, mechanisms matter more than opinions. Now let us talk about bail-ins because this is where many people misunderstand the modern banking world. In a bailout, outside money is used to rescue the institution. Usually taxpayers or central banks provide support. After 2008, that became politically toxic. People did not like the idea that banks could take risks and then be rescued with public money. So regulators developed another framework. Instead of taxpayers bearing the first losses, shareholders, bondholders, and in certain structures, large depositors or creditors may absorb losses. This is called a bail. Conceptually, it makes sense to policymakers. If a bank fails, those who had claims on the bank should bear losses before taxpayers do. But if you are one of those claimants, the concept feels very different. It means that money you thought of as in the bank may be treated as part of the bank's loss, absorbing structure, especially if it is above insured levels. Cyprus in 2013 made this real in modern times. Depositors over a certain threshold took large losses. Some deposits were converted into bank equity. People learned overnight that uninsured deposits could be used to recapitalize a failed bank. That was not an ancient Depression-era event. That was modern banking. And after Cyprus, bail and frameworks became part of the formal resolution playbook in major jurisdictions. The lesson is not that every depositor will be wiped out. The lesson is that legal hierarchy matters. Shareholders come first in line for losses, then certain bondholders, then other creditors. Depositors may be protected up to limits, but uninsured deposits exist inside the hierarchy. That is the third principle. You must know where you stand in the capital structure before a crisis, because during a crisis, the capital structure will determine who absorbs losses. People often ask, is my money safe? That question is too broad. The better questions are these: safe from what? Safe for how long? Safe under which legal framework? Safe up to which limit? Safe if one bank fails, or safe if the system itself is under stress? Safe in nominal dollars, or safe in purchasing power? Safe from bank failure, or safe from inflation? Safe from confiscation, or safe from theft? Safe from volatility, or safe from loss of access? Every form of safety is conditional. There is no perfect place for cash. There are only trade-offs. That is why the question, where should I store cash when banks fail, must be approached with humility. If someone gives you one simple answer, they probably do not understand the problem. Physical cash is one option. It exists outside the banking system. It cannot be bailed in. It does not depend on an app, a branch, a wire desk, or a functioning payment network. In a deflationary banking collapse, physical cash can become extremely valuable because prices fall and liquidity is scarce. In the Great Depression, those who had cash outside failed banks had optionality. They could buy necessities. They could buy assets from forced sellers. They could survive periods when banks were closed. But physical cash has its own risks. It can be stolen, it can burn, it earns no interest, it can be lost, and in an inflationary environment, its purchasing power declines. If the crisis is not deflationary but inflationary, cash can become a melting ice cube. You still have the paper, you lose what the paper can buy. So the right question is not, is cash good? The right question is, what kind of crisis am I preparing for? In a deflationary credit collapse, cash provides liquidity and optionality. In an inflationary currency decline, cash destroys purchasing power. The same asset can be prudent in one environment and dangerous in another. Treasury securities are another option. When you buy a treasury security directly, you are lending money to the federal government rather than to a private bank. In dollar terms, treasuries have historically been treated as the safest financial asset in the system. They are the collateral backbone of global finance. But here again, you need to examine the structure. If you hold treasuries through a brokerage, you introduce an intermediary. Your asset may be segregated, insured under different rules, and protected differently from a bank deposit. But there is still operational risk. If the broker fails, the process of recovering assets may take time. Time matters in a liquidity crisis. If you hold treasuries directly through the government, you reduce intermediary risk, but you may increase access friction. Selling quickly can be less convenient. Moving funds may require time. In a fast-moving crisis, convenience is not a small detail, so treasuries can reduce bank credit risk. But they do not eliminate all risk. Money market funds are another common cash substitute. People often think of them as cash, but they are securities. They invest in short-term debt instruments. Most of the time, they are stable and liquid, but they are not bank deposits. In 2008, a major money market fund broke the buck, meaning it fell below the $1 value investors assumed was stable. Redemptions were pressured, government intervention stabilized the system. Again, the lesson is not that money market funds are bad. The lesson is that every cash-like instrument has a structure, and every structure has conditions under which it can fail. Gold and precious metals occupy a different category. They are not someone else's liability. That is their great strength. A dollar is a claim within a monetary system. A deposit is a claim on a bank. A bond is a claim on an issuer. Physical gold is not a claim, it is an asset with no counterparty. That is why people have used it for thousands of years as a store of value. But gold also has trade-offs. It produces no income. It can be volatile, it must be stored, it can be stolen. And history shows that governments under extreme pressure can restrict or even outlaw certain private gold holdings. In 1933, the United States required citizens to turn in gold under Executive Order 6102. That is not an opinion or a rumor. It happened. So gold can protect against certain monetary risks while exposing you to storage, liquidity, legal, and political risks. It is a hedge, not magic. Foreign currencies and foreign accounts create another form of diversification. If all of your money is in one country, one currency, one banking system, and one legal framework, you have concentration risk. Holding assets in another jurisdiction may reduce that concentration. But this also adds complexity. Foreign accounts have reporting requirements, currency values move, legal systems differ, access can be affected by cross-border rules. If you are an American foreign bank account, reporting rules are strict, penalties for mistakes can be severe. So the point is not to hide money. The point is to understand jurisdictional diversification. There is a very large difference between legal diversification and secrecy. A well-designed structure is transparent, compliant, and understood. A poorly designed structure creates more risk than it solves. Real assets are another category: land, property, productive assets, commodities, tools, farms, businesses, things that exist in the physical world and have used beyond a financial claim. A bank deposit can be frozen. A bond issuer can default. A currency can be devalued. A real asset still exists. But real assets are often illiquid. You cannot spend a farm at a grocery store. You cannot quickly sell a property in a frozen credit market without taking a large discount. In deflationary collapses, real assets may fall in price because buyers disappear and credit contracts. In inflationary periods, they may preserve value better than cash. Again, no perfect solution, only trade-offs. This is where most people get stuck. They want the one answer that makes them feel safe, but the world does not give you a risk-free answer. It gives you a menu of imperfect instruments. Your job is to match the instrument to the risk, to diversify intelligently, and to avoid having one failure mode destroy your life. That is the fourth principle: do not optimize for comfort. Optimize for resilience. Comfort says, the bank has always worked, so it will keep working. Resilience says, the bank usually works, but I should understand what happens if it does not. Comfort says, the FDIC exists, so there is nothing to think about. Resilience says, the FDIC is valuable, but it has limits and processes. Comfort says, gold is safe. Resilience says, gold solves counterparty risk but creates storage and legal questions. Comfort says, cash is safe. Resilience says, cash solves access risk but creates inflation and theft risk. Comfort wants one answer. Resilience builds a system of answers. And this is where historical memory becomes valuable. In 1929 and the years after, the people who suffered most were not always the reckless. Many were ordinary, responsible people who had no framework for understanding institutional risk. They believed banks were storage facilities. They did not understand they were creditors. They believed stability was permanent because it had lasted long enough to feel permanent. That is one of the most dangerous beliefs in finance. Stability breeds the assumption of permanence. When nothing has broken for a long time, people stop studying how things break. Then, when the break comes, they discover the mechanism while they are trapped inside it. Cyprus taught the same lesson in a different language. Argentina taught it through freezes and currency conversion. Greece taught it through withdrawal limits. Iceland taught it through capital controls. Silicon Valley Bank taught it through speed. A modern bank run does not require a line outside the building. It can happen through phones, group chats, venture networks, and digital transfers. What took days or weeks in 1930 can unfold in hours. Technology has made access faster. It has also made panic faster. The system is more connected. Now banks hold securities whose values change with interest rates. They lend to each other. They face derivative exposures. They depend on confidence in markets, not only confidence in depositors. Interest rate risk is especially important. When rates rise quickly, the value of long-duration bonds falls. Banks that hold those bonds may show unrealized losses. If depositors remain calm, the bank can hold the bonds to maturity and avoid realizing those losses. But if depositors withdraw, the bank may need to sell securities at a loss. The realized loss weakens confidence. The weakened confidence accelerates withdrawals. The withdrawals force more selling. That is a feedback loop. And in systems, feedback loops are everything. One loss creates fear. Fear creates withdrawals. Withdrawals create realized losses. Realized losses create more fear. This is why banking crises can move so fast. They are not linear, they are reflexive. The system changes because people believe the system is changing. That is why I do not think about risk as a static number. I think about risk as a set of dynamic relationships: assets, liabilities, confidence, liquidity, interest rates, regulation, and political response all interact. If you look at only one piece, you miss the system. If you look at the system, you see why preparation matters. Preparation does not mean panic. In fact, good preparation reduces panic. If you know where your cash is, what limits apply, what your insurance coverage is, what part is liquid, what part is outside the banking system, what documentation you have, and what you would do if access were delayed, you do not need to react emotionally when stress appears. You have a plan. Most people do not. Most people outsource their thinking to normalcy. They assume tomorrow will look like yesterday because yesterday looked like the day before. That works until it does not. The purpose of studying 1929 is not to believe that 1929 will repeat exactly. It will not. History does not copy itself so neatly. The institutions are different, the tools are different, the policies are different, the technology is different, but the pattern rhymes. The pattern is that people treat liquid claims as if they are the same as owned assets. The pattern is that confidence hides leverage. The pattern is that insurance reduces panic until the event exceeds the scale of the insurance. The pattern is that governments change rules under pressure. The pattern is that those who understand the structure have optionality, while those who only understand the surface have dependence. That is the real lesson. Optionality. You do not prepare because you know what will happen. You prepare because you know you do not know. If all of your cash is in one bank, you have one point of failure. If all of your liquidity is digital, you have one kind of access risk. If all of your safety asset is physical cash, you have theft and inflation risk. If all of your hedge is gold, you have volatility, storage, and legal risk. If all of your assets are inside one jurisdiction, you have legal and political concentration risk. Resilience is not found in one asset, it is found in thoughtful distribution. But distribution must be practical. It must fit the person, a retiree, a business owner, a farmer, a family, and an institution. Do not all need the same structure. A person with $5,000 in emergency cash faces different trade-offs from a person with $500,000 above insured limits. A business with payroll responsibilities faces different liquidity needs than a household. You cannot copy someone else's system without understanding your own constraints. That is why principles matter. The first principle is to understand that a bank deposit is a claim, not a vault. The second principle is to know your insured limits and your uninsured exposure. The third principle is to separate everyday liquidity from long-term storage. The fourth principle is to diversify across counterparties, instruments, and where appropriate and legal jurisdictions. The fifth principle is to document everything because in a crisis the person with records has a stronger position than the person with only memory. The sixth principle is to avoid putting yourself in a position where you need instant access to every dollar from a single institution at the same time. These principles do not require fear. They require clarity. Now let us go back to the farmer in Nebraska. What destroyed him was not only the bank failure, it was the absence of any backup plan. His entire working capital was concentrated in one small local bank under a legal system with no deposit insurance in a period when bank failures could cascade region by region. He did what society told him was responsible. He saved, he deposited, he trusted, but responsibility without understanding is still exposure. This is difficult for people to accept because it feels unfair. And it is unfair. Many people harmed by banking failures did nothing morally wrong. They were not reckless. They were not greedy. They were not trying to cheat anyone. They were simply on the wrong side of the structure. That is why I never reduce these events to personal blame. The better question is not who was foolish. The better question is what structure created this outcome and how can a person avoid being trapped by it? That is how I think about history. History is not a storybook. It is a database of cause and effect. If you study the cause, you can reduce the probability of suffering the same effect, but you must be willing to look beneath the comforting language. Deposit insurance is confidence management bail. In authority is loss allocation. Emergency lending facilities are system stabilization. Capital controls are access restriction. Bank holidays are liquidity pauses. These terms sound technical because technical language makes harsh realities easier to administer. But the person experiencing them does not experience technical language. They experience a locked door. They experience a frozen account. They experience a denied transfer. They experience a rule change. They experience the realization that the money they thought was simply there was embedded in a system of claims, priorities, and political decisions. This is why education matters. Not education in the academic sense, practical education, knowing what you own, knowing who owes you, knowing what happens if they cannot pay, knowing what limit protects you, knowing what process applies, knowing how fast you can access liquidity, knowing what trade-offs you have accepted. Those are the basics, and yet most people never ask these questions. They ask whether the app works, they ask whether the interest rate is good, they ask whether the bank has a nice branch, they ask whether the brand is familiar. Those questions matter, but they are surface questions. The deeper question is this: what are the failure modes? If the bank fails, what happens if the payment network fails? What happens if withdrawals are limited? What happens if inflation accelerates? What happens if deflation hits? What happens if the government changes rules? What happens if your institution is solvent but illiquid? What happens if your account is above insurance limits? What happens if your broker becomes part of a resolution process? What happens if you need cash before the system reopens? What happens when you ask these questions calmly in advance? They are manageable. When you ask them during the crisis, it may be too late. That is why I think the central mistake people make is not trusting banks too much in normal times. Banks are useful. They are essential to modern life. The mistake is not knowing what kind of trust you are placing in them. You should not treat a bank like a safe in the floor. You should treat it like a counterparty in a system. Counterparties can be excellent. Counterparties can be regulated. Counterparties can be highly rated. Counterparties can still fail. And when they do, the rules matter. This is not cynicism, it is realism. A well-functioning system is still a system. It has design features, incentives, strengths, and weaknesses. The person who understands both the strengths and weaknesses uses the system better than the person who only believes the marketing. The modern world encourages people to keep everything inside the system because it is convenient. Direct deposits, automatic payments, digital wallets, brokerage sweeps, app-based transfers, and online banking all make life easier. Convenience is valuable, but convenience can become dependence. If every dollar you need is reachable only through one digital path, you have access risk. If every cash reserve you hold is at one bank, you have counterparty concentration. If every safe asset you own depends on one currency maintaining purchasing power, you have monetary risk. Again, the answer is not to run from the system. The answer is to understand your dependencies and reduce fragility where it matters. This is what wealthy families, institutions, and serious risk managers have always done. They do not assume one institution, one asset, one jurisdiction, or one instrument solves every problem. They build layers, one layer for transactions, one layer for emergency liquidity, one layer for capital preservation, one layer for inflation protection, one layer for long-term growth, one layer for access during disruption. Each layer has a job. When each layer has a job, you stop expecting one tool to solve every problem. A bank account is useful for transactions. It may not be the best place for all long-term liquidity above insured limits. Physical cash is useful for immediate emergencies. It is not a long-term wealth preservation strategy by itself. Treasuries can be useful for dollar safety. They do not eliminate all access or inflation questions. Gold can be useful as a non-liability asset. It does not pay income or solve every crisis. Real assets can preserve value across monetary instability. They do not provide fast liquidity. Foreign diversification can reduce single country risk. It introduces reporting and currency complexity. You must respect the trade-off. That is mature risk management. The immature mind wants certainty. The mature mind wants robustness. Certainty says, tell me what will happen. Robustness says, I do not know exactly what will happen. So I will build a structure that can survive several different outcomes. That is how you should think. Not because collapse is guaranteed, not because banks are evil, not because there is a conspiracy, but because machines do what they are designed to do. The banking machine creates credit. It supports growth. It moves money. It allocates capital. It makes modern commerce possible. It also creates more claims than immediately available cash. It depends on confidence. It depends on maturity transformation. It depends on regulators making the right decision at the right time under pressure. It depends on political willingness to intervene. It depends on depositors not all wanting out at once. Those are real dependencies. Understanding them is not paranoia, it is literacy. And once you see this clearly, the story of 1929 stops being a dusty historical anecdote. It becomes a warning about first principles. The farmer was not ruined because he was financially irresponsible. He was ruined because he confused a claim with control. That is the same mistake people can still make today, even with better regulations and modern insurance. They see a number on a screen and call it money. Sometimes it is money, sometimes it is a promise, sometimes it is insured, sometimes it is uninsured, sometimes it is liquid, sometimes it is temporarily inaccessible, sometimes it is protected by law, sometimes it is exposed to resolution rules. The screen does not show you those distinctions, you have to know them. And if there is one thing I want you to take away, it is this. Do not wait for a crisis to learn the legal status of your own cash. That is too late. Learn now. Look at where your deposits are held. Look at which institutions hold them. Look at which balances are insured. Look at what is above limits. Look at how quickly you can access funds. Look at whether your emergency liquidity depends entirely on one system working perfectly. Then think in scenarios. What if a bank fails? What if transfers are delayed? What if markets close for a few days? What if inflation weakens purchasing power? What if deflation creates a rush for cash? What if your broker, bank, and payment apps all depend on the same underlying liquidity pipes? You do not need to assume the worst. You only need to stop assuming the best. That shift alone makes you more resilient. Most people never do this because normal life rewards passivity. The system works, so they do not investigate it. Then, when stress arrives, they are forced to learn quickly in an environment designed to punish slow understanding. That is how people get trapped. They are not trapped by one bad decision. They are trapped by years of unexamined assumptions. The assumptions are simple. The bank is safe. The government will fix it. The insurance covers everything. Access equals ownership. A balance equals control. A large institution cannot fail. A familiar brand means security. A modern app means liquidity. History is old and irrelevant. Each assumption contains some truth, That is what makes them dangerous. The bank may be safe most of the time. The government may intervene. Insurance may cover you up to defined limits. Access may function normally. Large institutions may survive. Modern systems may be more resilient than old ones. But most of the time is not the same as under all conditions. And risk management is about the conditions that do not look like most of the time. The next banking stress may not look like 1929. It may not involve people standing in long lines outside branches. It may be digital. It may be fast. It may be handled with emergency facilities. It may be papered over with new programs. It may be contained. It may not affect you directly. But if it does affect you, the key question will not be whether you believe the system was generally safe. The key question will be whether your personal structure was resilient enough to handle interruption. That is why preparation is so important. Preparation is not prediction. Prediction says this will happen on this date. Preparation says several things could happen, and I want to make sure none of them destroy me. That is the right mindset. It is the mindset that separates people who react from people who respond. Reaction is emotional. Response is structured. The farmer in Nebraska had no chance to respond because he had no structure outside the failed bank. Your advantage is that you can learn from his experience before you need the lesson. You can see that a deposit is a claim. You can see that insurance has limits. You can see that bail-ins are part of modern resolution language. You can see that physical cash, treasuries, money market funds, precious metals, foreign accounts, and real assets each solve one problem while creating another. You can see that the goal is not to find the perfect asset. The goal is to avoid a single point of failure. That is the principle. No single point of failure. Not one bank, not one currency, not one legal structure, not one access method, not one assumption. If you build your financial life around that principle, you will think more clearly than most people during stress. And clear thinking is one of the most valuable assets in a crisis, because when panic comes, prices move, rumors spread. Institutions issue reassuring statements, politicians speak, regulators improvise, and people who never studied the system suddenly try to understand it all at once. That is when mistakes happen. The prepared person does not need to understand everything in that moment. They already understand enough. They know what they own. They know where it is. They know what trade-offs they chose. They know what they will do first, second, and third. That is the value of studying history. You are not trying to scare yourself. You are trying to remove surprise. Financial disasters are most destructive when they combine loss with surprise. If you are surprised, you act from fear. If you expected that the system could fail in certain ways, you act from principles. So let me close the loop. In 1930, a man walked to a locked bank door and discovered that his money had become inaccessible. He had done the conventional thing. He had trusted the institution. The institution failed. The law gave him little recourse. The system moved on, but his life changed. Today, the system is stronger in some ways. It is also more complex. Deposit insurance exists. Central banks exist. Regulators exist. Emergency lending facilities exist. But leverage exists too. Duration mismatch exists. Uninsured deposits exist. Bail-in frameworks exist. Capital controls have existed. Inflation exists. Political discretion exists. And confidence remains the load-bearing wall. Do not confuse complexity with safety. Do not confuse regulation with invulnerability. Do not confuse a digital balance with unconditional control. The banking system is useful. Use it, but use it with your eyes open. Know the difference between access and ownership. Know the difference between insured and uninsured. Know the difference between liquidity and solvency. Know the difference between a safe asset and a safe structure. Know the difference between being calm because you understand the risk and being calm because you have not looked. Those are not the same. If you take this seriously, you do not need to become fearful. You become more rational. You become more prepared. You become harder to trap. That is the real lesson of 1929. The people who survived best were not necessarily the people who predicted the exact crisis. They were the people who did not put all of their trust in one fragile point of the system. They had options, they had liquidity, they had assets outside the broken channel, they had time. Time is what liquidity buys you. Options are what diversification buys you. Clarity is what education buys you. And in a crisis, those three things matter more than almost anything else. The next crisis will have a different name. It will come through a different door. It may begin in interest rates, commercial real estate, regional banks, derivatives, sovereign debt, currency pressure, or something almost nobody is watching today. The trigger changes, the mechanism rhymes, too many claims. Not enough immediate liquidity, confidence breaks. Rules change. Those who understand the structure move with discipline. Those who do not understand wait in line and hope someone opens the door. I would rather understand the structure, and I would rather you understand it too. Because once you understand where your money actually is, you can stop depending on hope. You can build around reality, and reality, however uncomfortable, is always the safest place to begin.